Most people are taught to buy low and sell high, find a beaten down stock and wait for recovery, profit. Well, that sounds logical. It's also statistically wrong, at least for the kind of trading that I do. I only trade stocks that are already going up, stocks that have already proven themselves, and there's a very specific reason for that, and it's called momentum. And it's probably the most documented anomaly in financial market research, actually. Momentum means that stocks which have been strong over the past 6 to 12 months have a statistically higher probability of continuing to be strong over the following month, and stocks that have been weak tend to stay weak. That was first demonstrated by Jegadeesh and Titman in 1993. They ranked thousands of stocks by their past returns, bought the top performers, shorted the worst, and that strategy returned roughly 1% per month consistently and over decades. Since then, this has been replicated across more than 40 countries, over 200 years of US market data, and across every asset class, stocks, bonds, currencies, commodities. And here's the thing, even after the research was published and everyone knew about it, the effect didn't go away, it persisted. So it means it's not a fringe idea. This is one of the most studied phenomena in finance, and I use that for my trading. So a lot of people miss that about momentum. It's not about win rate, it's about asymmetry. For example, when I trade momentum setups, I don't win every time, of course, nobody does. A realistic win rate is somewhere around maybe 50%, more or less. That means roughly half of my trades don't work out. But here's the thing, the ones that do deliver disproportionately large returns. A winning momentum trade can deliver 5x, 10x, sometimes 10x or more of your initial risk. And a losing trade costs you 1x. That's the asymmetry, and that's part of the risk management as well. So even if you're wrong more often than you're right, the math works in your favor because your winners are fundamentally larger than losers. That's what momentum gives you. It's not certainty, it's really probability tilted in your favor combined with asymmetric payoffs. And there's a structural reason this works. When a stock has strong momentum, it means capital is flowing into it, buyers are in control, the trend is established. So you're not betting on reversal, you're joining a move that the market has already validated. That's really, really important. So you're swimming with the current and not against it, basically. When you buy a cheap stock that's been dropping, you're doing the opposite. You're hoping for a reversal against the prevailing flow of money. So you might be right occasionally, but the probabilities are against you in that case. So the momentum is element 1 of the 6 things I look for in every trade, and I have a separate video on that. It's the foundation. Without it, I don't even consider the rest. So let me show you. So look at this stock before the consolidation even formed. Strong, sustained move over a month. That's momentum. That tells me the market has decided, capital is flowing into these stocks, there is definitely buyer's interest. Now from here, I'm looking for other 5 elements: a clean consolidation pattern, an obvious resistance line, contraction of volatility toward the end, a decisive breakout, and volume confirmation on that breakout. But here's the critical point. If I showed you the exact same consolidation pattern on a stock that was flat or declining, it would look very similar on the surface, same shape, same structure, but the probability behind it is completely different. The momentum is what separates a high probability setup from a coin flip. My screener filters for this automatically. It only returns me stocks with a strong prior momentum. So by the time I'm looking at the chart, the first filter has already been passed. I'm only looking at stocks that the market has already chosen. And this feels wrong at first, honestly. These stocks don't look cheap, they look expensive, they've already gone up 50, 80, 100%, and I'm buying them. But expensive is a value investor framework. For a momentum trader like myself, a stock that's up 80% and consolidating tightly under a resistance line isn't expensive, it's building energy. And if it breaks, the same force that drove the first 80% drives the next leg. And the data backs it up. As we said, 30 years of research across every market, momentum really works. If you want to see the full 6 elements I look for and my complete daily screening routine, I have a free swing trader playbook at investorhorizons.com. Link in the description. See you in the next one.